You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zax Investment Research. Learn more by visiting them online at zax.com. Welcome to another Profit from the Pros. I'm Terry Ruffalo. We closed out a roller coaster of a first quarter this week on more of a subdued note that it began on. But subdued or not, stocks logged in their third straight quarter of gains, and the Dow its best first quarter in more than a decade. International events remained in focus, as did deal-making activity this week. A report showing a tumble in consumer confidence didn't seem to rattle investors' cages at all. Portfolio repositioning ahead of the quarter's end helped to keep investor sentiment more upbeat this week. Retail, energy, and telecom were among the stock groups in focus. There was also more good news on the jobs front as the government reported the U.S. economy added a more than expected 216,000 jobs in March, bringing the unemployment rate down to 8.8%. And we'll be talking more about that a little bit later on at the roundtable. So, Shiraz Mian brought you in here to give us a little bit of an overview here. How does the trading this week stack up as far as end of the quarter window dressing? Is that what we saw most of? Because there's a lot of back and forth this week.
I would say it had some role. Momentum is a reality in the market, and we always see that at the end of the quarter. But I don't think there was the driver for the turnaround in stocks that we saw over the last couple of weeks. The market's momentum was driven, in my view, by a reassessment that these global headwinds and clouds, Japan, the Middle East, oil, they will not derail the U.S. recovery. And once the market zeroed in on it, it didn't take it long to take the market back to its mid-February high.
So let's talk about that a little bit. Let's talk about those clouds. You know, they haven't gone away, despite the party on Wall Street. So do you look for the market to be more resilient in Q2?
It'll all come down to how these economic reports about the health of the consumer, about the labor market, about the industrial manufacturing activity that reassured the market to get back to its previous highs. If we keep that momentum going, like the employment numbers that you talked about this morning, mm-hmm. If we see this momentum, then I would be looking for resilience in Q2 as well. But tentativeness would come to the forefront if, for example, we don't sustain another labor market report in April, May, or we have some slowdown on the manufacturing side. So then in those circumstances, oil prices, debt issues in Europe, they come to the forefront and will weigh on stocks.
All right. Mike Vodka, equity strategist, let's bring you in here to talk a little bit about earnings season. 2 weeks is when the next earnings season starts for Q1. And, you know, we hear a lot about during earnings season the earnings surprises. But there's something that we call the real earnings surprise. Tell us what that is.
That's right. From a technical perspective, an earnings surprise is defined as a company that beats the consensus estimate. The consensus estimate's 15 cents and the company comes in at 16 or 17 cents. Mm-hmm. But the reality is that the street sort of creates its own unique expectations around these earnings events. One great example would be technology companies. You'll frequently see technology company beat by a couple pennies, but their share price goes lower because what happened is the street was actually expecting it to come a little bit stronger. So a real earnings surprise is an EPS surprise that actually catches the street off guard, and you'll see shares jump higher on it.
So how can investors then benefit or profit from these real earnings surprises?
Well, I was going to go over 2 ways that they could do that. The good way to do it would be to buy any company that posts a positive earnings surprise, because what academics have found is that a company that surprises, their share price tends to outperform the market over the next 6 to 9 months. Another thing to do under the category of a good way to benefit would be selling any company that misses on an earnings surprise. If you miss, then they typically underperform for the next 3 to 6 months or so. But moving down the line, the best way to profit from earnings season is to find those companies that are on the cusp of reporting the earnings surprise. Now, granted, there's no magic 8-ball or secret recipe to finding those companies, but there are a couple of things that investors can look at. One is paying attention to individual estimates. If you see individual estimates rising into the number, it's a signal of bullishness. Another thing you can look at is the 30-day consensus. If the 30-day consensus rises into the earnings event, then that's also another bullish indicator for investors.
Okay, Mike, thanks. Shiraz, as far as next earnings season is concerned, you looking for another season filled with positive growth?
I do. I think the momentum that we have seen over the last few quarters remains in place. There are a few issues that we would be watching closely. Margins, the outlook for margins would be a key thing that we want to see what managements are talking about. After all, there's been a huge run-up in commodity prices, oil as well as others. So we need to see if the momentum in margins that's been driving earnings thus far will remain in place, or it'll have some stumbling.
Okay, thank you both. We'll see you later at the roundtable. Hope to see you coming up after the commercial break. Stay with us. Here is your Bull and Bear stock of the week. An auto parts manufacturer and a shoe company make up this week's Bull and Bear of the Week. Shiraz Mian here with me once again to fill us in on the reason for each being what they are. Superior Industries International, SUP, the ticker symbol, is the auto parts manufacturer. They are a bull because?
They are a play on the positive outlook for the global auto industry in general, the U.S. automakers in particular. Okay. They are a manufacturer of aluminum wheels and provide to almost all the global automakers, primarily in the U.S. And it's not only the outlook for auto sales over the coming years, it has significantly improved since the major downturn, but then there are some structural benefits that the aluminum wheels have over the steel wheels, and which is helping their product gain market share at the expense of steel and iron wheels, and that's primarily the reason. They had a very impressive quarterly result just a couple of weeks back, really blowing the consensus estimates out of the park. And the estimates, the margin, the top line expectations, all have been going up for this company. And on top of this very solid growth story, valuation is fairly reasonable. And you wouldn't typically expect a $600-700 million company to be paying a dividend, but they do, and it's fairly juicy, 2.5%. So overall, a pretty good company.
Well, they have no debt on their balance sheet.
That's right.
So that's another positive.
That's right. So very solid cash flows, impressive balance sheet, and they don't shy away from sharing that with the shareholders.
Skechers USA, SKX, the ticker symbol, is the bear of the week. Now, I can remember when people were singing the praises of Skechers.
That's right. It was a high flyer. They had supposedly invented the shoe that would help people lose weight and tone up their bodies.
Right.
And they did pretty good, 2009, 2010. But they have fallen on harder times. My personal view is that if a company is negatively surprising the market on quarterly results one quarter and then again, as Skechers has done, then there is something major wrong with management and their inability to communicate with the street properly and to set up and anchor expectations properly. And Skechers has missed in each of the last 2 quarters. Why have they missed? The shape-ups, the hot product that they had, has fallen on harder times. More competition has come in the market, and they are no longer the only provider of that hot product on the market. So inventories are piling up. They're finding it difficult to push that product in the retail space, which is forcing them to discount it. All of that is showing up in under pressure margins, and estimates are coming down. And I personally don't think there was just a 2-quarter story, I think management doesn't really have a good control over what's going on with the situation.
Yeah, that from what you're saying seems to be the core issue, not just competition.
That's right. It's not.
Maybe a business model that needs more fine-tuning.
They were way too reliant on this one product, and there were no barriers to entry for other competitors to come in and provide the same thing. And as those came in, the pressure built up on them.
Okay, stock screening next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. We're screening for earnings acceleration this week with Kevin Matris, our top stock screener, market technician here. It's particularly timely because earnings season is just a couple of weeks away, right?
Right. Yeah, it is. It's very timely. All my articles are timely.
Well, but this is particularly
right,
timely.
particularly.
Right.
Yeah, now is a good time to look at it because, in both good markets and bad markets, earnings and earnings estimates and all of this stuff, this is, one of the most important things that drives stock prices. But instead of only looking at just the last quarter's earnings, we're going to be focusing on earnings acceleration. So you're looking at multiple periods of earnings growth.
So what I'm hearing is it's not just about the earnings, but it's also about the rate of the growth.
Exactly. So the reason why we're doing this is because studies have shown that the most successful stocks in the past have displayed earnings acceleration before their biggest move has occurred. So, if you're looking at decent earnings, but let's just say that the growth is kind of like sideways in a range, right? Nothing that keeps on building from one period to another.
Yeah.
That's good, but it's not great. Or if you're looking at good numbers, but let's say they're decelerating, that also could be a sign of concern. Sure, you've got a good number that printed out, but maybe that means the stock is getting ready to consolidate or possibly getting ready to start pulling back or getting ready for a fall. So looking at the difference between the growth rates from one period to the next, that can really be the deciding thing between a good stock and a great stock. So you want to take a look at what is the growth rate in this most recent period, and is that growth rate bigger than the growth rate from the previous period? And this is kind of what the whole screen is about.
All right, set it up.
All right, so we're going to be starting off by looking at increasing percentage earnings growth and projected percentage earnings growth.
Okay.
So again, I want the last 2 quarter-over-quarter EPS growth periods to be greater than the previous periods. And I want the next projected quarter-over-quarter EPS growth period to be greater than the previous periods as well. And that is what those 3 items at the bottom of this screen are focusing on, okay? In addition to that, this screen, I am just making sure that the stocks are over $5, and I prefer to look for stocks that are trading over 100,000 shares on a daily basis. Okay. You can throw in some additional filters if you want, but this screen in and of itself, just the way it is, produced, I believe, 40 stocks when I ran it this morning.
Oh, so what did you get to come through?
Well, here's 5 from that list. We have Buffalo Wild Wings, Constellation Energy, Goodrich Petroleum, Health Management and Associates, and TK Corp. So again, I would say that since we are approaching earnings, when a company reports, take a look at what they had said, but take a look at the growth rate from this one period and take a look at the growth period from the previous quarter and see, is it increasing or is it decreasing? This is a very key element. And again, like I said earlier, since statistics have shown that some of the best stocks have seen accelerated earnings before their most impressive price moves, these are things you definitely want to be putting on your radar screen.
All right, and while particularly useful during earnings season, useful really anytime, right?
It's useful anytime, and of course, not every single company fits into a specific, earnings season. There are a lot of companies that report in off periods, but it's always good to be able to see, is that growth rate increasing? And if it is, definitely put that on your radar.
All right, end of the quarter and employment numbers up next at the roundtable discussion. Stick with us. Welcome to the Zax Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zax.com. More jobs and more market momentum. That's what we're talking about here at this week's Roundtable and those top stock picks of the week. Let's run down the players one more time. Shiraz Mian, Research Director, whom you've already met in the program, as you have Kevin Matris, Market Technician, Earlier in the show, Tracy Reinick joins us again this week, equity strategist, to kick around these topics, maybe a few more if we have some time. So Tracy, does the good news on the jobs front this week, lower unemployment rate, an economy adding more jobs in the private sector as well as everywhere else, does this underpin the economic recovery in your opinion?
Yeah, I think it does. It was a solid number. It wasn't great. It wasn't bad. We're going in the right direction. This is all good. Some of the underlying data with it is a little bit more on the positive side. The longer term unemployment's a little bit better. The temporary workers a little bit better, but we still need a lot to do on the jobs front. But it's definitely giving a boost that, coming through the rest of this year, things are looking up.
Right. So 8.8%, the new rate for unemployment, is a 2-year low, according to what I've read. Kevin, do you think we can finally say that the jobs picture is good?
Well, yeah, I mean, it is improving. I did like the unemployment number because it lends credibility to my prediction that we will be at 8% by year's end. But I think that this underscores that we are on a sustainable trajectory. And if you were to look at the total numbers, this was the best total monthly gain in 9 months. It was the third best total gain since the recovery began, and it was the best private sector gain in years. And again, the most important part to be able to identify in this report is that the private payrolls increased by 230,000 jobs, and you could see widespread job gains across all of the industries. So I really do believe this bodes well for strength in the entire economy.
All right, Shiraz, so that being the case then, how should investors be interpreting this news?
They should get reassured that these global issues that had investors reassess the sustainability of the recovery. This should reassure them that yes, in addition to all the other positives that we had been seeing in the economy, on the manufacturing side, on the labor market side, we finally have the government payroll numbers consistently 2 months in a row coming out positive, and this could be the beginning of the turnaround in the labor market. Let's not forget that the unemployment rate has extremely rapidly dropped, about 1% in the last 4 or 5 months.
Well, you talk about the turnaround in the employment market or unemployment market. I saw something earlier this week, or one company came out with a story that indicates employees are ready to say, "I quit." That's how confident they are. I don't know if that's such a good idea at this point, but what does this do to the Fed's Goldilocks scenario about keeping rates lower longer?
There is still plenty of slack in the labor market and in the broader economy, which should help the Fed be comfortable with this idea that pricing pressures, though we are seeing some initial early signs because of the commodity price pressures, that inflation is not a problem. Notwithstanding that guy who is ready to quit his job, the rest of the labor market and the rest of the employees out there, they don't really feel confident enough to walk into the boss's office and start demanding a pay raise. Till that time, the inflation picture will remain mild and muted, and that's what the Fed is looking at. They want to have the employment picture improve, but at the same time, the pricing picture not become dangerous and ominous.
Okay, Tracy, this news, did you want to add something?
Well, yeah.
You look like, wait a minute, I don't agree with that.
I kind of disagree because just because employees aren't getting pay raises doesn't mean we're not going to have inflation throughout the economy. As we saw even just in the last couple of days, Krispy Kreme says they're raising prices on donuts. Hershey's is raising prices on all their candy bars. Yep. A couple of the manufacturing reports we just had came in, and they all said that pricing pressures are now an issue in China, India, which we've seen more inflation. But even here, the recent reports we're getting from here, it's all about the input costs. Yeah. So that is going to have a bigger impact to me than if employees are getting pay raises.
All right, that takes me to something you wrote earlier this week, and that is investors are seemingly ignoring the elephant or elephants in the room.
Right.
And the party continues on Wall Street. What's going on here?
I don't know, but I mean, I'm not betting against the bulls, that's for sure. I mean, it's very bullish sentiment, and they are ignoring everything that's going on that could impact it so far in the world between, our debt issues, Eurozone crisis, the stuff happening in Libya, Japan,
Right.
everything.
Yeah,
So
seemingly, but we don't know why, Kevin. Do you?
Well, I mean, there's a bunch of elephants in the room. The other elephant is that corporate profits are surging, the economy is on the mend. So if you only looked at the negative, you would miss out on this absolutely historic rise. So you have to be able to take advantage of the opportunities that are present. Be cautious, be wary, but absolutely take advantage of what's right in front of you.
All right, points well taken. Give us your top stock pick of the week. Charles.
It's directly related to the labor market,
Yeah.
manpower. It's a global staffing firm. About 2/3 of their operations are abroad, and they have a direct exposure to the improving global labor market scene. So a very good stock.
All right, Kevin.
Mine is Valero Energy. They're an oil refiner and marketer. Not only do they do refining for crude oil, but they also do a lot of ethanol and this kind of thing. They're a top stock, top-ranked industry. They hit some fantastic surprises their last time out. Real quickly, my price target is short-term 35, long-term 45. That is a 17 and a 51% price gain from here.
All right, Tracy.
my stock pick is Agrium, which is a fertilizer company, but they also do seeds and crop protection. Commodities are hot and the farmers are rich, so they're going to be buying a lot of products. They're trading only at about 12 times, and their earnings are expected to grow about 55% this year based on higher prices for their fertilizers plus demand.
Yeah, so we have to keep an eye on that commodity story yet. We can't count that story out just yet, right?
That's right.
All right, we've got earnings season coming up in a couple of weeks, but the news this week, Kevin, seems to underscore your Dow prediction.
Yeah, it looks like we're going to at 13. First off, we got to get through 12.4. But if we get through 12.4, I really do think 13.1 is a target, and maybe a lot more.
Is 12.4, is that where you see resistance?
Well, that was the recent high, so if we can get through there, I think we could aggressively pierce that level.
All right.
Fingers crossed.
Okay, we'll keep our fingers crossed. Meantime, I'm not going to quit my day job just on this news, and won't suggest that for you either. But thanks for joining us, and we'll see you next time on Profit from the Pros.